Welcome, my name is Marty Schenkman and I'm joined by Jonathan Blotmacher, and we're going to talk about one of his favorite topics next to fly fishing, split dollar life insurance. So why don't you first define what split dollar is for those that may not be familiar with it, and then let's just have a little bit of a discussion about the current state of split dollar and what's happened.
Split dollar insurance is not a type of insurance, but it's often confused, but it's an arrangement in which the proceeds paid upon the death of the insured, and sometimes the premiums are divided or split among different taxpayers.
So it's a way to pay for insurance. It's who's paying for it.
Yeah, historically it came about because companies would say to an executive, "We own a policy of insurance on your life, and we're going to own the cash or investment component, and when you die, we will get the amount of that component or the premiums we paid, whichever is greater. But you can control any additional death benefit." And the way the rules worked is that there was a de minimis amount of income attributed to the executive, or if the executive had assigned his or her interest to a family member or to a trust, a very, very tiny gift. The rules have changed tremendously, and in fact the world on split dollar changed radically on September 17, 2003, when the IRS issued detailed regulations. To make a long story short, it's a way in which you can buy insurance and pay premiums, even a single premium, without making an enormous gift. And that's by either, again, dividing the way the proceeds will be shared upon death, or by making a loan. And the split dollar loan rules are very, very explicit. It's under section 1.7872-15. And it tells you what you need to do. But basically,
it's like a cookbook, and if you follow the rules, that shall be characterized as a split dollar.
Yes, they're very, very clear that if you follow the rules, you're going to get the result. And in fact, they even go so far as to say if you follow these rules, we, the IRS, can't come in and say, well, it really wasn't a loan transaction. It's very, very generous. Why would you want to do it? Well, if I want to have my family have insurance coverage, but I don't want to outlay an awful lot in the way of gifts, I can loan money to the trust, and the trust can give me back a note, and the note doesn't have to be paid until the insured, in this case me, until I die. And the interest is that low applicable federal rate of interest under section 1274D.
And you don't even have to pay that currently.
No, you don't. You can. Well, they explicitly allow it to accrue. So it's a way to fund the insurance in a manner in which you won't have to have a big cash outlay that constitutes a gift.
So historically, when we had, say, $1 million exemption and somebody wanted to buy a meaningful sum of insurance, the split dollar loan could be, let's say, a parent loaning money to a trust. Instead of making a gift, the trust would buy the insurance, but there wasn't the large gift transfer if, say, it was much larger than what Crummy Powers would support.
That is correct, and keep in mind that it may not be wise to use your lifetime exemption of now $11.18 million to buy life insurance, because the life insurance may be dropped before the insured dies, in which case you may have wasted it.
The statistic I recall reading was that 98% of term policies are never paid.
That's correct.
So you got to be careful what you use it.
Even if you have a cash value policy, even one that does well from an investment perspective, if the insured lives too long, it probably is not a good investment at the end of the day. But if you're buying insurance, say to protect your family or to have key person insurance for a business, insurance may make great sense, even if you have to hold it for a long, long time. But you don't want to wind up having adverse gift tax consequences, and split dollar really can help there.
Just a point, many of these older split dollar transactions that were done when we had $1 million exemption or a $2 million exemption, you want to revisit those and see if it makes sense to unwind them. You can make a gift to the trust, for example, and have the trust repay the loan and unwind the transaction by using the much larger exemptions that now exist. And I'm concerned that there's still plenty of these old transactions out there that, you know, are on autopilot and no one's really revisiting them.
Well, recently people have tried to use split dollar loans to reduce gift and estate tax by saying that
Well, isn't that the economic benefit if we're going to get into Cahill?
Yes, in the economic benefit, this is the one where you divide the proceeds upon death. And if I advance, say, $1 million for the premium, I'm going to get back the greater of that $1 million or the cash value at the time that I die. But if, and as from my perspective, that would be the same. I die, the note has to be repaid, or the proceeds are going to be paid. We're not going to get very far. But say instead of having the insurance on my life, I advance the funds, but it's on the life of one of my grandchildren. Well, when I die, what is the current value of the right for me to get back that $1 million, maybe 60 years from now, because I have a young grandchild? And people took the position.
This is often referred to as intergenerational split dollar.
Right, it's intergenerational because we're insuring the life of a much younger generation person. And it's not until that younger person dies that I would be entitled to my share of the proceeds back. Well, that discounts could be enormous. In some cases, taxpayers have reported something like a 97% discount in valuation. So you've advanced $1 million of premium, you die, you're entitled to get that $1 million back, or cash value if it's greater. But typically what happens with a policy is cash value goes up, but if you live too long, that cash value will go down again because the cash value is being used to pay the remaining premiums. So again, you make a loan in effect it's a loan of $1 million, and when you die, you say, oh, the value to me, what's in my estate now, to get this money back 60 years from now is something in the neighborhood of maybe $50,000. So you get a 95% discount in valuation.
The recent Cahill case was a case where the taxpayers did exactly what you talked about, using economic benefit regime. I believe the number was something like it was a $10 million advance to an insurance trust that actually was made by the son, one of the sons. The son is the son as a successor trustee under the father's revocable trust when I believe the father was incapacitated, and the father died, I believe, within about a year of the transaction. And the value that they had attributed to the right that the advancing father, really through his revocable trust, of the $10 million was something like $187,000 or maybe less.
Maybe it was even less.
Number.
It was a very small number. I mean, the discount again was in the range of 98%.
But an important point: nothing that came out with the negative ruling in Cahill, which we'll explain in a second, suggests that split dollar doesn't work. The Morissette case about a year ago confirmed that split dollar works. What Cahill started to evaluate and address, and it was a settlement, so we still don't have a case on it, but people are concerned about what it means for intergenerational split dollar, is not that split dollar doesn't work, but what is the value involved. So if you're looking to use intergenerational split dollar to generate a significant discount in value, you need to be concerned. You want to talk a little more about Cahill?
No, I think that's it. I think you'd have to be pretty aggressive now to say, I'm going to do a traditional Cahill type transaction.
Economic benefit, intergenerational, discount for estate planning purposes, 90+%.
Right. If it's on your own life, in other words, if I advance the money, they're buying a policy on my life, and I'm going to be repaid, or my estate or my former revocable trust is going to be repaid, you're not going to get much of a discount in valuation. And as you said, Marty, there still are reasons to do split dollar, so you don't have to make a big gift up front.
So for larger estates doing significant planning, it's a great tool.
It can be a phenomenal tool.
Right. And the benefits remain. Just not, well, we don't know for sure, but it appears not the large discounts on intergenerational split dollar. The Cahill case settled. The Morissette case is still, I think we're waiting to get a settlement now. We haven't seen it yet. And there's a third case, Levine, which I believe is also pending. And I think there was just another recent case whose name escaped me that somebody just sent me that I have not had a chance to look at.
I haven't seen it.
At any rate, split dollar, all existing plans should be reevaluated because of the change in exemption in law. And maybe some of them should be unwound. Split dollar is a great tool for leveraging wealth into a trust to buy life insurance. It's just not necessarily assured, and perhaps risky, I don't know what terms to describe what happened in Cahill, to try to get significant discounts using economic benefit arrangements on an intergenerational split dollar plan. Any last words?
Well, the way you take a look at the Cahill case exactly, it may be that you can amend the form of the transaction so you don't really fall under Cahill, and maybe you'll get a better result. Maybe you could get some discount.
Okay. Thank you for joining us. This program was presented for educational purposes and was not either of us providing any tax or legal advice. Good luck.